It's time now for our 360 round. For that, let's bring in our panel to discuss Uber. Shares under pressure after the company reported weaker than expected earnings, right now trading down about 3.75%. Joining us now to help us break down these numbers, David Clement, North American Affairs Manager at Consumer Choice Center, and Jamie Meyers, analyst at Laffer Tangler Investments. Thank you both for being with us. Jamie, let's start with you. What were some of your key takeaways from the report we got from Uber today?
Hey, good morning. Thanks for having me. Key takeaways are that things are still going well. Uber is a member of our Best Ideas portfolio. We also own the convertible bonds in that portfolio. But overall, gross bookings accelerated. They were up 22%. Trips were up. Mobility was up. Delivery was up. And, I think we've learned something over the last few years, and that's people want delivery, whether it's Uber, Walmart, McDonald's. That's what they want. But, the important thing is that management sees things accelerating in 2026, and it's going to be broad-based. Advertising continues to compound. That's a $2 billion business now. And the important thing remains that, management's optimistic. The fears being driven into the stock are from the AV market, the autonomous vehicle, and, we think that those will be dispelled over time.
And David, Jamie just mentioned that we saw the bookings and the EBITDA beat, but we did see EPS come in light. We saw guidance come in light here. Do you also view things as going well, like Jamie does?
Yeah, to be honest, I do. Trip growth, even if you look at the rural growth, which is relatively new, and I think what's the most interesting about the projection moving forward is the subscription base in Uber One, and some of the metrics on the number of Uber users who haven't yet used one of the delivery services available through Uber. And so there's an immense potential to tap into consumers and make more of those consumers dual users. Obviously, there's higher profits associated with that. But the kind of subscription and member model, if that continues to grow, I believe it's around 36 million or so. If that continues to grow, what you do is you just have significantly better retention across the board, across the full platform of not just mobility, but what the other things that Americans are going to want to order to their houses.
And so, Jamie, you both agree things going well for Uber, but I'm looking at their chart and they're near a 9-month low despite beating on some of these very important metrics. What is the market missing or misreading here?
It seems to us that, and it's not just Uber, it's other parts of the market that are being threatened by AI in terms of software. It's the risk of disruption, and it's high. We'll be completely honest. But the risk of disruption for people like us at Laffer Tangler as long-term investors creates opportunities to get into the stocks lower. We do think that the AV concerns will be dispelled over time. We don't think it's going to be a zero-sum game. What we're seeing right now is that these first-party vehicles, the companies that own the vehicles, they're underutilized. And unfortunately, that's a losing proposition for them. So putting on the Uber platform makes sense. We also think that it's going to be a relatively slower transition than people might be expecting. Things are going well in cities like San Francisco for Uber in terms of autonomy, but every city's different. So, in terms of the fear, it's being driven in the stock. But when you look at it, going out this year or even next year, it's trading at a PEG ratio of less than half times the stock price. And so we think it's relatively cheap. But, the president of our firm, Arthur Laffer Jr., likes to call this an economy in transition. And unfortunately, things get muddied in transition.
And David, you highlighted Uber One in your answer, your first answer. They now have, I'm looking, 46 million members. It's nearly half of all their bookings here. Does that fundamentally change Uber's long-term margin structure? Because there seems to be a lot of concern about margins when I'm looking at some of the commentary post-earnings.
I think it does, because the margins and profitability are going to be higher when you don't have consumers kind of bouncing between competitor apps. Like if you look at grocery delivery, if you have gotten someone on a subscription and they're in Uber One, and let's say they're traditionally having maybe dinner delivered once a week, and then you introduce the option of having something like groceries, and then you enter that rather competitive space in terms of grocery delivery, the opportunity to generate more revenue per member is obviously significantly higher. And so I think if we see that growth long term and the ability to retain those subscriptions, you're going to see higher revenue per user just by virtue of members using Uber as kind of a multi-purpose platform, right? It was once thought as just the way to get around, and now it's becoming so much more than just that.
And they're certainly reflecting that, too, with just the app updates. They're no longer Uber Eats separate from Uber. It's all encased in one location. But, Jamie, let's talk about this delivery perspective here. It's a $100 billion run rate business, with grocery, retail, Uber Direct gaining a lot of traction here. Does delivery quietly become a profit engine that's being underestimated right now for Uber?
We think so. Absolutely. Over the last couple of years, we've sort of expected delivery to taper off, but that's not what's happened. We found that people want delivery. They want it fast, and they're willing to pay for it, importantly. You're seeing it at Uber, where people are willing to pay more for delivery. You're even seeing it at companies like Walmart, where a third of people are paying for expedited delivery. So we think the penetration continues. Likely it'll be driven by international, where you see that they're only in about half the areas that they are in terms of mobility. So there's a lot of room there. Grocery and retail, we expect to continue. Uber Direct has been a very big hit, and it's really appreciated by the companies that use it. Darden has called it out a few times on their earnings calls. So, we think the business continues to scale. In the short term, it'll be driven by the narrative. The bears are loud. They're hard to disprove in the short term, but the fact remains that the fundamentals are strong.
And David, last question coming to you. The other headline we're getting out of Uber's earnings is they're getting a new CFO. Does that matter at all for the stock, or is this still entirely about the narrative and sentiment here for Uber?
I'm not sure. It may play some role. We're seeing some of the pressure today based on kind of investor expectation. But I agree with what my colleague here has said. The general optics are great. And just going back on the delivery side, this is an anecdotal example, but this will give you some light in terms of when the light bulb goes off for consumers. My daughter's now 3, but when she was younger and in diapers, the ability to be like, oh, I've forgot to pick up diapers, and yes, I paid a premium to get them, but to then have them delivered to my house in 20 minutes, and then applying that across the various different aspects of the average American's busy life, the opportunity there on the delivery side is just so immense beyond what we maybe traditionally thought as having a burrito delivered for dinner. It's now so much more than that, and I think as that plays out throughout the remainder of 2026, we're going to see a lot of expansion, especially in traditionally underserved areas like rural and suburban areas.
Oh, all of us parents have been there when we need to get those diapers, and that delivery is clutch in those moments. Thanks for highlighting that and reminding me of something I'm grateful not to be in anymore. Thanks to David, Clement, and Jamie Meyers for joining us today.